When we examine the titans of the American financial landscape, few possess a history as deeply intertwined with the nation's own narrative of expansion and reinvention as Wells Fargo and Company. From its iconic stagecoaches traversing the untamed West to its current status as one of the Big Four banks, Wells Fargo's journey offers a compelling case study in strategic adaptation, aggressive growth, and the profound consequences of corporate culture. This is a story that spans over a century and a half, marked by pivotal mergers that built a coast-to-coast empire, but also by ethical failings that have necessitated a period of deep introspection and operational overhaul. To understand Wells Fargo today, we must first trace its origins back to the Gold Rush era, where its very identity was forged in the crucible of the American frontier. The genesis of Wells Fargo dates back to 1852. A time of immense opportunity and upheaval in a rapidly expanding America. Founded in San Francisco by Henry Wells and William Fargo, the same entrepreneurs behind American Express. The company was strategically positioned to capitalize on the economic boom fueled by the California Gold Rush. The initial business model was a brilliant dual-pronged strategy perfectly suited to the demands of the era. On one hand, the Wells Fargo Express Company provided essential transportation and logistics services, moving goods, parcels, and, most critically, gold and currency across the vast and often perilous territories of the American West. On the other, the Wells Fargo and Company Bank offered vital financial services, accepting deposits and providing credit to the miners, merchants, and settlers who were building new communities from the ground up. This symbiotic relationship between banking and transport was fundamental to its early success. The company's stagecoach, emblazoned with the Wells Fargo name, became more than just a mode of transport. It evolved into a powerful symbol of reliability, security, and the extension of organized commerce into the nation's most remote frontiers. In an environment defined by risk and uncertainty, the presence of a Wells Fargo office or stagecoach signified a connection to the established financial system, providing a foundation of trust upon which economic activity could flourish. This deep association with the development of the American West established a brand legacy of resilience and reach that would prove invaluable for centuries to come. As the 19th century gave way to the 20th, the technological landscape of the United States underwent a dramatic transformation. The proliferation of railroads rendered the stagecoach obsolete, forcing Wells Fargo to pivot its core strategy. The company methodically divested from its express transportation business, sharpening its focus exclusively on the banking and financial services sector. Throughout the early and mid-20th century, Wells Fargo embarked on a path of steady, regional consolidation. Through a series of strategic mergers and acquisitions with other Western financial institutions, the bank progressively expanded its footprint. These were not the headline-grabbing mega-mergers of a later era, but rather a calculated series of moves that solidified its position as a dominant regional player, synonymous with banking in the American West. This period was crucial for building the operational capacity and stable capital base that would serve as the launchpad for its future national ambitions. The modern history of Wells Fargo, however, was fundamentally redefined during the wave of banking, deregulation, and consolidation that characterized the late 20th century. The pivotal moment arrived in 1998 with the acquisition of Norwest Corporation, a Minneapolis-based financial powerhouse. In a deal valued at approximately $29 billion, what was technically a reverse merger saw the more operationally efficient and diversified Norwest acquire the historic Wells Fargo. However, in a masterstroke of brand strategy, the leadership of the combined entity, led by Norwest's CEO Richard Kovacevic, chose to retain the Wells Fargo name and its San Francisco headquarters. They astutely recognized the immense brand equity and historical resonance of the Wells Fargo name, particularly its association with the American West, which far outweighed the recognition of the Norwest brand. This single transaction was the catalyst that transformed Wells Fargo from a major regional bank into a formidable national competitor, dramatically extending its market presence deep into the Midwest and laying the groundwork for a truly coast-to-coast network. The new Wells Fargo adopted Norwest's highly effective, sales-centric cross-selling business model, to become both a driver of immense profitability and, ultimately, a source of significant controversy. A decade later, amidst the turmoil of the 2008 global financial crisis, Wells Fargo executed another transformative acquisition that solidified its place at the apex of American banking. As the crisis sent shockwaves through the financial system, Charlotte-based Wachovia, then the fourth-largest bank in the United States, found itself on the brink of collapse due to its heavy exposure to risky mortgage-backed securities. In a dramatic turn of events, Wells Fargo outmaneuvered Citigroup to acquire Wachovia in a government-backed all-stock deal. This acquisition was a strategic coup of immense proportions. Not only prevented the catastrophic failure of a systemically important institution, but also allowed Wells Fargo to aggressively expand its retail banking, wealth management, and investment advisory services across the East Coast, a market where it previously had a limited presence. The integration of Wachovia's vast branch network instantly cemented Wells Fargo's status as a dominant national player in nearly every major financial market in the country, placing it firmly within the elite tier of America's Big Four banks alongside J.P. Morgan Chase, Bank of America, and Citigroup. However, the relentless pursuit of growth and the high-pressure sales culture championed since the Norwest merger would ultimately lead to one of the most significant corporate scandals of the 21st century. In 2016, the world was stunned by revelations that, between 2011 and 2015, Wells Fargo employees had illicitly created approximately 2 million unauthorized bank and credit card accounts in customers' names. The objective was to meet impossibly aggressive sales quotas and earn performance-based bonuses. Subsequent investigations exposed the root cause, a toxic, high-pressure sales culture relentlessly focused on a metric known as GR8, which pushed bankers to sell an average of 8 different financial products to every customer. This go-for-broke incentive structure, which had once been lauded as a key driver of the bank's profitability, had created a perverse environment where employees felt compelled to engage in fraudulent behavior to keep their jobs and meet management's expectations. The consequences of the fake account scandal were immediate and severe. The bank was hit with an initial fine of $185 million from regulators, a figure that would grow as further misconduct in its auto and mortgage lending divisions came to light. The reputational damage was catastrophic, shattering decades of carefully cultivated customer trust. The scandal led to the abrupt departure of CEO John Stump, the clawback of executive compensation, and the termination of thousands of employees. In the years that followed, Wells Fargo was forced to invest billions of dollars into remediation, strengthening its internal controls, overhauling its risk management frameworks, and fundamentally reforming its corporate culture. The Federal Reserve, in an unprecedented move, imposed an asset cap on the bank, constraining its ability to grow until it could prove it had rectified its governance and control deficiencies. In the aftermath of these challenges, Wells Fargo has been engaged in a multi-year effort to rebuild its foundation. The bank has taken drastic and necessary steps to restore trust, most notably by eliminating the product sales quotas for its retail banking employees that were at the heart of the scandal. The focus has shifted from aggressive cross-selling to improving customer satisfaction and strengthening operational oversight within its branch network. Today, Wells Fargo remains one of the largest financial institutions in the United States, with a vast retail banking network that, as of 2020, included approximately 5,229 branches. The company's current strategic imperative is centered on optimizing its operations, simplifying its business model, enhancing its risk management capabilities, and, above all, restoring its brand reputation. The path to full recovery is an ongoing process, but the bank's leadership is now tasked with proving that it can prioritize long-term ethical conduct and customer centricity over the short-term sales targets that once defined its identity. In retrospect, the history of Wells Fargo serves as a powerful and cautionary tale for the financial industry. It demonstrates how a legacy built on trust and reliability can be rapidly eroded when a corporation's culture loses its ethical compass in the pursuit of growth at all costs. From a stagecoach on the frontier to a global financial behemoth, the company's evolution reflects the broader narrative of American capitalism itself, a story of innovation, ambition, and the perennial struggle to balance the drive for profit with the imperatives of public trust and corporate responsibility. The future of Wells Fargo will depend not on its ability to execute the next big merger, but on its capacity to fundamentally embed a culture of integrity and customer primacy into every facet of its operations.